Welcome to Mark Arnold's Finance. We're going to talk about this huge deal where Kroger is set to buy out Albertsons for $25 billion. It's made some initial big headlines, but I think this huge earnings week has kind of dampened that and people have kind of forgotten about it. But this is a big deal. And I want to talk about it, especially from a unique perspective, because hint, hint, I used to work for one of these companies. Through my high school and college years, it was a great job. And so I'm going to just give some fun facts about the grocery business and things that, I've seen from my perspective. So this will be a great video. Also, if you're new to this channel, be sure to subscribe. I'm somebody that is very transparent. I share my portfolio performance with every single video, whether it's in the red or the green. I share the good and the bad, and that's something that not a lot of YouTubers do. So if you appreciate that transparency, be sure to subscribe. Now let's look at my portfolio, and it's made some huge improvements. It was in the red by almost 11%. Now it's fallen to 7.46% in the red, which is $3,400 of unrealized loss. So we've seen some companies pop back into the green. One of them is Amazon. So they're definitely all rising. It's kind of a rising tide because of earnings week. We've seen Bank of America provide great earnings. Netflix was a great surprise. And there's just this positive momentum that's kind of lifting up all the stock market right now. And so if we start to see some of the big companies, especially next week with the tech companies, if anybody presents numbers that are below estimates or projections, that will be a big negative, I think, for the market. So it's going to be a bumpy ride, I think, this next week and a half. And so with that said, let's jump right into this video. Kroger is set to buy Albertsons for that $25 billion that I mentioned, and this is a huge merger. In fact, if we look at the largest retailers in the US, you'll see Kroger is in the 5th spot and Albertsons in the 10th. Walmart is in 1st, then Amazon, Costco, and Home Depot. But Kroger and Albertsons, by them combining, they're going to create a lot bigger of a company that's going to be able to compete very well with the likes of other grocery stores. And speaking of the grocery market, Walmart does control 20% of it, followed by Kroger at 10%. And then you have Costco in 3rd, and then I think Amazon is in 5th. But post-merger, Kroger and Albertsons will have 15% of the market share, so it'll be bumped up from a 10 to a 15%. Now, Albertsons is about half the market value of Kroger, and we'll see that later on when we hit my metrics chart, which we're going to compare these companies to each other in the industry and to see if these are good investments. Now, as far as grocery stores go, just to kind of give you some more background on this, we'll see here that Albertsons and Kroger, they have many different stores that they run underneath them as subsidiaries, shall we say. So for Albertsons, you'll see here they have Safeway, Vons, Acme, Jewel-Osco, a lot of these companies. And with Kroger, you will see the same thing. With the Kroger stores, you'll see certain ones as Dillon's, Fry's, Ralph's, Smith's Food and Drug, which is here in my town of Albuquerque. And so what grocery stores do, because you might be asking yourself, why aren't all these companies called Albertsons or Kroger? What happens is they go into these markets and they buy out these smaller grocery chains. And because in those markets, those chains are very well known, they don't want to change the name because they think that people will see that as, hey, they're not going to be the same quality or what we're used to, and they'll just go shop somewhere else. So it's their strategic way of buying them out but not changing the name, and that holds retention of the customers. And if you think about it, if I had a grocery store called Mark's Grocery and someone else bought me out and changed it to Joe's Grocery, a lot of people would say, I really like Mark's, so I'm going to go try Kyle's Grocery. And so it just prevents people from switching at a high rate, their customer, their retention, and that's why these stores do that. That's the main reason. So if we look at location-wise, we will see that Albertsons is mainly on the West Coast with all their subsidiaries and their main store. Of course, here in New Mexico, there's a lot. And then with Kroger, they're mainly in the Midwest, but they are spread out across the U.S. as well, as you will see here. So combining this kind of makes sense because that's going to give them a good balance between East and West. And so I think that's one of the reasons why they have looked at merging, but there's some other reasons why they looked at merging, which we'll talk about here in a second. But I do want to mention that this deal is expected to be challenged by regulators. It's going to be an uphill battle. Of course, this merger will boost profits. That's what Kroger came out and said, that this merger is going to boost profits. Of course, it's going to be better for them to negotiate with vendors, so it should bring down prices for consumers. But what people aren't thinking is, yes, it's a grocery business. It should produce, more money on the grocery side of things, but there's a whole retail advertisement side of it that I don't think people are seeing that is huge. You think of Amazon, right? When they sell things and people click, it automatically notes that and alerts other advertisers to be like, hey, you should be advertising over here. Because of that, you need to pay us more money because we're giving you all this kind of cheat sheet of where to advertise that of people's interests. And we know who's interested in it. And so you need to pay us more. So the retail media market is what it's called, is one of the fastest growing advertisement sectors. And with the grocery stores like Kroger and Albertsons, you can tell a lot by someone's grocery cart, what they buy. And so if someone's buying ramen noodles and Red Bull, obviously that's a college student. If someone's buying kids' meals and a family lasagna, that's a family. If someone's buying a lot of meds off the medication aisles, could be someone that's elderly. So there's a lot of things that they can gather and then really hone in those advertisements towards those people. And so this combined data is just going to make their targeting of these advertisements more valuable. And that's where they can make some big money. Now, I think it's different every state. I know Kroger, which it's the Smiths here in New Mexico, you have a membership. I don't think you pay for it. But of course, by scanning that every time, I think that really helps them gather even more data. Albertsons does not have a membership scan card, but I'm sure there's ways that they gather data regardless, per store, per sector of a city, a state, the country. There's many ways that they can target these advertisements for higher value for them getting more profits. So it's definitely very interesting. And that's a side I don't think people are seeing. I think they're seeing like the grocery side, the vendor side, but not the advertisement side. And that's where these two companies are going to combine and become huge. So with the advertisement dollars, this merger would make Kroger and Albertsons the number 4 player in the $41 billion retail ad market with 13% share. So it's really going to boost them up. Now, Kroger and Albertsons are mostly union. It wasn't union where I was at, but I did hear about it, and they would try to come in and make us union. Our managers would talk with us, so on and so forth. So this is why they want to merge to compete against the non-union stores that are having very successful growth, such as Walmart, Amazon, and Costco. These are all highly successful companies. And so Kroger and Albertsons want to combine to help compete, right? It's all about surviving. And so there's also another store called Aldi. I've heard about this. Of course, this comes out of Germany, and it's a discount store, supermarket store chain that is raising some competitive concerns with stores in the US. So this is another reason why these two stores are combining into one big grocery chain. They will sell some of their stores that overlap in certain markets. So, if there's a big concentration of Albertsons and Krogers, they will be selling, and that should help their argument towards the regulators of why we should be allowed to combine, because we're being responsible about this. So again, grocery prices have risen 13% in the month of September compared to last September. So inflation is hitting hard. So a lot of people, regulators, there's been some big political names raising concerns about this deal, saying they're only going to increase prices because it's going to take out competition. It's going to be more of a monopoly. And of course, Kroger responded by saying that the merger would actually help reduce prices. And that is true to an extent. So of course, when two big companies merge, you look at Amazon, Walmart, they are able to have very low prices because they have that negotiation power. And that's where Kroger and Albertsons, their hopes is that because they're going to become a lot larger, they're going to be able to negotiate better prices for us consumers. So there's also store brand items. Every store basically has these, but by combining Kroger and Albertsons, that's going to just increase the spend on those store brand items instead of the big national name brands. And Kroger is saying that that should help keep those big companies in check with their prices, because we're going to come in and charge less, and that should bring their prices down as well. It's a lot that they're saying that this will be a good thing for consumers, but of course there's concern about this merger. that it could force out competition, create more of a monopoly, and in the end, these companies will be able to charge whatever they want because there won't be that many other options. And so there's definitely both sides of this, and I respect either side that you might be on, but as an investor, that's what this channel is about. I think this is creating a very exceptionally good deal for you if you own Kroger or Albertsons. So what I'd like to do now is Albertsons did just report earnings, so let's see how they did. So Albertsons actually beat, so this was another company this week to just beat their earnings, their estimates. So their adjusted earnings were 72 cents and their revenue was 17.9 billion, and that beat the expectations by 65 cents per share or 17.7 billion. So they are definitely doing well, beating expectations, and that's a good sign for us to go into the metrics chart. So what I do with this, if you're new, I put in some of the more important ratios, measurements, and metrics that I feel are important to look at as an investor. I put them in here for the company. So Albertsons ticker is ACI, and on the right, Kroger is KR. And so what I did is I highlighted in green or red anything that has a large deviation from the industry average. So if it's in the green, that means it's positive compared to the industry average. If it's red, that means it's a negative and lower number than the industry average by a decent margin. So let's start with the PE ratio. These both kill it here. They are inexpensive when you look at their PE ratio trailing 12 months. Of course, Albertsons is even lower, but they are a smaller grocery chain, where Kroger has, I think, a little bit more brand value, name recognition, and future growth prospects. Earnings per share trailing 12 months versus prior trailing 12 months, they both have grown massively. Now the 5 years, we'll see Albertsons has grown great, but Kroger hasn't. They've only grown 1.14%. Revenue has been in line with the industry, so they have decent revenue numbers, nothing that's red flag. Cash flow, Albertsons is doing great at 12.58%, where Kroger is at 0.75%, so I don't like to see that. They both pay dividends, so the dividend yield with Albertsons is low at 1.82, and Kroger is just so-so at a 2.47. Right now, savings accounts are getting close to that Kroger amount of their dividend yield. I think it's at a 2.25 in high yield savings accounts, so not very attractive dividends, but their 1-year growth history is impressive. They're both above 20%, at or above, shall we say. The dividend payout ratio, I really like Albertsons. It's very low at 17%, but Kroger's is still healthy at a 32%. Total debt to assets. Both these companies have higher debt to assets than the industry average. I don't like to see that. I like anything below 50%. So Kroger is, better, but Albertsons is just above that. So they need to improve their numbers here. Their gross margins, Albertsons is really good compared to the industry average, as well as their return on equity. So that's really great to see, and a very big thumbs up for me. I love to see that. Now, shares outstanding, Albertsons is newer to the stock market, so this could be why, but their shares outstanding are going up. So they're diluting their shareholders, where Kroger isn't. They're bringing down their shares outstanding, making anyone who owns those shares own more of the company. Now, the market caps you'll see here, Albertsons is half of what Kroger is at a 14 billion versus Kroger's 30 billion market cap. So overall, the debt I don't like to see, but the return on equity and gross margins with Albertsons is fantastic. They are low in their PE ratio. So I will say this, by these two companies combining, I think that's just going to create a lot of strength, because on their own, they're strong. They stand their own ground, but together, I think they're going to be able to compete a lot more with Walmart, the Costco, the Amazon type of companies, which are superior to, I think, Albertsons and Kroger. So I think this is a great move. Shall it happen, right? There's a lot going against it, but I do think it could happen. I think there's more of a probability that it will go through, because they do have some good points on their end, right? They do have these larger retailers to say, hey, they're just going to be taking from us. We need to create some more competition on the higher end of those market leaders. And so, yes, I do think these are good investments in the consumer staples sector. So everyone needs to buy groceries. Everyone needs to eat. And I think these are well-known and liked grocery chains, the big parents and all their subsidiaries. And so a unique perspective from my end, just a few things with the grocery stores. When I worked there, there's definitely a science to how they set up grocery stores. So of course, everything at eye level are their high gross margin profit items. So they want people to grab those. Of course, the end caps is really where they try to promote a lot of their gross high profit margin items as well. And then they set up the grocery store so you're kind of forced to walk through it. And so a lot of the times you'll see the produce section first. And let's face it, as Americans, produce isn't probably one of our biggest buyers, and it should be, but that's going to force us to walk past it to the back of the store. They kind of help try to create that flow. You think of Costco, that's a good setup, right? You want to go all the way through it like a U shape. So grocery stores have their own kind of method, and even to the music that they play different music at different times of day. So when it's a slower time of the day, they'll play soft and slow music. They want people to take their time. When it gets to those busy hours, they play a little bit faster music. Pay attention next time because they want people to kind of get in and get out so it's not so stressful for the buyer. There's so much kind of psychology stuff that goes into it. It's pretty fascinating. And working at the stores, I will say, was a great job for high school and college, and I think they do provide some great careers in certain parts of the stores. So I do think working for these companies, I do think they have a future. I don't think they're yet to a point where they can compete with the Costco or with the Walmart, but by combining, I think they can get there. So I think it's a positive thing, and even if you buy it for the prospect of just having it as more of a safety company, that's fine. I think there is a chance that there could be some decent growth in the future with this merger. So with that said, let me know what you guys think of this merger. Would you be buying either of these companies? Do you see them more as a safety, slow growing kind of company to get into, either one, or as combined? Or do you think that these will grow massively because they have more opportunity to innovate and grow their customer base, where kind of Walmart and Amazon and Costco have kind of maybe reached some peaks in some areas? I don't know. I'd like to hear all your opinions on this. And thank you guys so much for watching this video. Be sure to subscribe, and we'll see you next time on Mark Arnold's Finance.